The other big move in the market today, of course, hitting its highest level against the yen since '90. For more on that, Kathy Lien of BK Asset Management joins us. Kathy, I wonder where you think we are in terms of chapters of stress and how much longer this can go on.
Well, I think what you have to look at is, in the near term, the U.S. Fed policy is the most aggressive. But Fed fund futures are pretty much pricing in 5% rates, which is basically what's priced into the U.S. dollar. So while I think that there could be another push higher, we got above 150 in dollar yen. That was very important for investors. I don't think that we're going to see much more momentum. I think for long-term investors, if they're looking at the U.S. dollar, now might be the time to be scaling into those dollar short trades, because while the Fed is almost certain to raise interest rates by 75 at their next meeting, confirming this move in the dollar, I don't think they have much more of a surprise for the investors to really get them back into additional long dollar trades.
Kathy, it's Tim. Thanks for joining us. But this move in the end is so extraordinary, and it's so extraordinary, and the reason part of it is the BOJ is paying no attention to inflation, or so it seems, and they seem to be so mismatched in terms of the differential here on policy. Does that concern you? Because people talk about yen, and they talk about it in terms of policy failures and systemic, and this is the stuff that, frankly, I think a lot of equity investors don't get a chance to look at every day.
You're absolutely right. I mean, Japanese have really struggled with managing the currency and managing also, where inflation is at. And they're under a lot of stress because, at the end of the day, the yen is weak, bond yields are rising, and they're really pushing against that 0.25% 10-year yield cap. So the Bank of Japan has a policy meeting next week, and they really need to take action. I don't think they're ready to, but if they really want to, put a halt to this move, I think they need to start talking about raising interest rates and catching up with the other central banks.
Kathy, currency crisis is now a term you're starting to hear more and more of. And listen, the moves in developed market currencies are unprecedented. How close are we? Are we in the midst of one now?
Well, I think, it's definitely a crisis for a lot of countries. And I think it's, we are in a very sensitive position because central banks are really pressing the gas at a time when all of these growth factors are starting to show signs of weakness. So I'm worried. I think that, we may be in a situation where growth could really break down very aggressively, very quickly across the globe, and the currency factor won't be able to, pick up the slack. And I think, overall, it could become a serious issue.
Last one, Kathy. Goldman today, we're inclined to think that the UK fire has been arrested and that the UK story will now move to the back burner. You think the pound said that today?
I completely agree. I think that the U-turn that they had in terms of ousting the prime minister and Jeremy Hunt throwing out those tax cut plans is going to lead to a U-turn in the British pound. I think that the market, the way the pound is moving now, saw this as a positive move by the UK government. It's going to restore confidence because a lot of the policies they completely caused a chaotic mess in the UK markets. So I think we're going to get to calmer times, and the pound had dropped to very, very weak levels. We're going to see bargain hunters relieved by the latest political developments.
Kathy, appreciate that. Kathy Lien, let's trade this, Karen. I wonder what you make of that currency picture and how it's creeping into every big either earnings guidance, analyst day, or corporate result.
Right. I mean, we saw P&G, for example. We're going to see it again and again and again. It's interesting. Sometimes the market really cares and, penalizes them, and sometimes the market sort of looks through it. I feel like
that's when there's bigger fish to fry, like there are right now.
And, I think, though, that now everything is sort of through a negative lens. Even you see things like, UNP, while it doesn't have a currency issue, just the sort of general downtrodden economic feeling, recession looming or here already, I don't know. So I feel like we will get penalized for FX hits.
Q, how long have you been with the CNBC, the network? Many years.
20.
20 years!
Maybe a little more.
So you have a good memory. You're a lot young. How often have you talked about currencies in your 20 years? I guarantee not that often, but recently.
This is the third time.
Well, think about it, though, and it's coming into your morning show without question. The fact that we're talking about currencies as often as we are and the bond market volatility is problematic. That's been something we've been talking about in the show.
Doesn't that mean we're near the end of this, though?
I don't think so.
The dollar's been rising for a year and a half, and I don't think you're saying it might not be. And I know Dan's got a position
I can understand why you would say that.
I just feel like we're out of place, and if you read that Bank of America's fund manager survey, I mean, long dollar is the most crowded to trade, even for people that don't really buy the dollar. It's their view. So ultimately, I think this is a tailwind. I think we haven't heard about the dollar from the multinationals because I think there are bigger issues out there. I think we're going to hear a lot of it. It's a great time to throw excuses out there. But using the dollar as a headwind from here on out, I think not. And I think actually you start to see the BOJ get in gear. The yen's going to actually strengthen substantially.
So maybe we are at some sort of a point, maybe an inflection point, given what Tim said. I'll buy that. But, the volatility is not going away. And my point all along has been bond market volatility, which we have in spades, and now currency market volatility will manifest itself in the equity markets. And to a certain extent, we're starting to see that. So none of this, by the way, is healthy. None of this is a good sign. And if we do reverse, it's probably going to reverse in a meaningful way. And all this, at a certain point, I guess, everything makes its way into the equity market, and I don't think we're there yet.
Yeah, that's a really good point. When you think about the sort of volatility we just have seen in rates and we've seen in currencies and obviously commodities over the course of this last year or so, I mean, the sell-off in the stock market, the S&P down 22%, feels really orderly. And we know, yeah, that VIX seems pinned in the high 20s or 30 or whatever. I think that really means to me that a lot of people who can hedge are hedged. That doesn't mean that they're wrong. It doesn't mean when I see those stats, about, put buying last week versus call buying and this, that, whatever, that's going to go poof and those people are wrong. It means that sentiment has shifted. So maybe we've just become sophisticated enough, and to Guy's point, that it's sooner or later it does have to work itself in the stock market. As I've said it on this desk a lot. I mean, we've had how many panicky days in the stock market this year? Last Thursday, that reversal. But look at where the S&P is right now. It acts horrible given the velocity of that reversal last week. So to me, I think next week is going to be a really big week and just for the market.
This week, as much as people seem to be making this assumption that rates are stabilizing. Rates have gone up every single day. The 10-year's gone from basically 358 to 420 in the course of 9 sessions. And if you look at Fed fund futures, and we talked about this last night, not only are they now north of 5%, or I didn't see the close, they certainly are over 5% today, but they're moving out the futures curve, which means it's going to take longer to get to that place. It's going to take longer to plateau. And rates are a big problem. A 10-year, you change your equity valuation for equities when you discount at a higher discount rate on the 10-year. So it just, these are all things that I think, unfortunately,
but you agree, though, the fact that the S&P just acts the way it does here, just hovering above those recent lows, it acts almost so complacent.
I think it's going to be very difficult to not plumb lower on the S&P with rates moving higher. And I think down 26 doesn't make sense with all the other volatility we see.
Yeah, certainly reflected in all the Fed speak this week, too.